It's good, guys. So what I want to do today is basically review something that isn't, basically what I would regularly trade, which is, regular FX pairs, USD, Euro, Pound, etc., right? But in actuality, this is an index, right? And what is this YM1? This is basically another way of saying Dow Jones, US30, right? But I personally like using this more just because it gives better pricing. The price moves smoother and it matches more to the broker that I use, right? So first off, what you want to realize on the monthly time frame is the fact that we're experiencing basically the most bullish market there is, period, right? Like we haven't seen any type of slowdown. All I see is consistent higher lows. Even if you want to consider this a breaker structure to the downside, it didn't react to the downside. What I mean by that is that yes, we created a lower low, but we didn't create a lower high. In actuality, we created equal highs, so that then that downside move was only a retracement to continue higher, right? So what I want to realize, what I want to notice, or basically look at from this time frame, is this closure from last month, right? What is this telling me? This is telling me that there is a ton of pressure to the upside still, right? Also, something to notice from this time frame, we see a ton of bearish pressure in basically coming into play here, 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 and here. But notice price is failing to continue lower. Therefore, this selling pressure isn't doing anything, so it's showing an unwillingness to continue lower. And now with this basically very bullish closure, now we can expect some higher upside move, right? So just by knowing that bias, right, let's see what happened this week. All right, so first off, I want to notice where we opened for the week, right? So we opened for the week 8, 10, right here, right? So since we know our bias is up, there's something that you guys should basically realize with this, right? And the fact is that if you're looking for swing buy positions, you want to basically find a position below the weekly open, before the daily open, right? Or not before, under, I'm sorry. A price point lower than the daily open and the weekly open, right? So the first thing that basically comes into mind is this right here. This very impulsive move, leaving inefficient pricing, right? So I'm going to go to the daily time frame, right? So this is our open of the week right here, right? But notice beforehand, we see, why isn't it doing this? All right, it doesn't work. Okay. So what I see is inefficient pricing here. Therefore, what you want to mark up is relatively 50% of that and relatively the closure, right? So when we go back to the open of our weekly, right, which is right here, we see a reaction coming from the 50%, the relative 50%, but we're leaving equal lows, right? So what we want to do is we want to zoom in there. Right, notice that we're getting equal lows forming, and then those equal lows are purged to complete the inefficiency to then continue higher. But now how do you enter off of that, right? So you want to go, let me just mark this off, go down to the 1 minute. Right. So what do we see here? right? When we're looking at this, right? Obviously, this whole thing is an accumulation schematic, right? From a 1 minute time frame, right? So you see, right, your first secondary test, your preliminary support, etc., your secondary test in phase B, and then we get our spring, right? So notice that this spring is valid because we took out the liquidity, we purged liquidity, and we basically closed that daily inefficiency. All right, so that's enough confluence for me to try to guess this low here. But obviously, you don't want that entry. You want the safe entry, right? So you could accommodate your stop based off of that entry. So what you want to do is obviously this is the last down candle, right? You want to measure 50% of that, right? And what is something I like to do? I like going to the 2 minute time frame. Right? And I do the same thing here. I'm going to highlight that 50%. And we have now basically created a little zone of interest, right? And notice how price came into that zone basically to the T. So what is that there? That can be considered my LPS due to the fact that we broke a structure right after that. And all of this is just your sign of strength, showing that this is the final distribution of sell orders to now accumulate buy orders. And so now that's when you take off, right? So let's say you miss this entry, right? You could have been aggressive with this, you could have been conservative with this, right? You could have considered that 30 point stop, and your first target. Let me go to the 5 minute. Right, that would have been a pretty big stop. Your first target would have been previous high, 2 to 3, 4 to 1, 5 to 1, etc., 6 to 1, blah blah, right? Or you could have been a whole lot more aggressive with it and put your stop right under that zone. Why? Because there's enough confirmation in that zone, enough validity in that zone, and the fact that we rejected off of it shows that it was valid, right? So now your first high is 9 to 1, your second high is 21 to 1, right, etc., etc., etc. So that's a nice little intraday trade, right? Let's say you missed that. Let's go down to our lower time frame. Right? In order for us to sell down here to then react upwards, we have to have sell volume come in there to accommodate for those previous orders to then move higher. But that means that the positions that were here are now, in drawdown. So we do the same thing for this candle. And look at that. Straight to the T, 50%. This is now the safest entry you can have because you've gotten your change of structure. Right, that'll be a 12 point stop. And now you're taking this to the first high, which is 4 to 1. Your second high, which is 11 to 1. Third high, which is 15 to 1. Or obviously, if you're looking for some sort of swing trade, then you want to take that higher, right? But obviously, you need to have those intraday targets just because you don't want the pullback to basically make like a 90%, 88% retracement so that then, you're basically, you didn't take any profit. So you basically just wasted your time, right? And that's the problem with swing trading is that sometimes you're going to see trades literally come back right to your entry, when in reality you should have had intraday targets, to pay yourself back, right? Or take multiple positions so that some are intraday targets, some are swing targets, etc., right? So after that last move up there, you see, right, a very impulsive move, which leaves inefficient pricing, right? There's buy orders in here, but there is no sell positions to basically accommodate for that, right? Which is why it's called an imbalance in pricing. So this was our last sell to buy candle. So obviously you want to mark up the open of that and then the relative 50% of that, right? Because that could become something interesting later. And guess what? It did, right? So now from a swing perspective, this is probably your best entry. Why? Because now in a higher time frame, you have taken out loads of structure. So now this is merely just a pullback back into discounted pricing, so that then we can continue higher, right? So this is the trade that you would have wanted, right? Because now, since you have an accumulation schematic and you left a sell to buy candle, there is so much validity in this move, right? Let's say you took your position off of the 50, and let's say you took another one off of the open, right? So your stop would be you could put it right under that 13, 7, right? Obviously your first high here is 14 to 1. Next is your swing high, that is 29 to 1, etc., etc., etc. So that's bread, that's all you need to know. It's bread. And that even that conservative position in the open would have been 7 to 1 and even 15 to 1, right? And that's just, that's crazy, right? So what we do now is we look at smaller time frames to see what actually happened here. Right, so you get that full reaction. Right, so notice we have a very impulsive move to the downside, but there's like zero volume to support this. Right, in fact, there's more volume. Sorry, hold on. There's more volume here than there is in the actual impulsive move to the downside. Right, so that's also adding validity to our potential move, because you see that volume isn't as high as it once was back up here, right? But price is still continuing to impulsively head down, which is showing that that is a sign of weakness, because this is an unsupported move. So when there's an unsupported move, there's usually no, how do I say, there's no, right? It just shows that it's not a real move. Like, there's a word I'm looking for. Basically, it's showing you that it's a false move, right? Just because volume is saying one thing and price is saying another, and that creates that divergence that I tell you guys about. It doesn't necessarily have to be price and volume like that. All it has to show is that price, right, is doing one thing and volume is doing another, right? And by price, I mean the momentum, right? That's something that I told you guys in that previous Zoom, which is that ratio between momentum and volume. Is understanding that ratio will tell you direction of price, right? So even if you miss that low, all right, let me do this, go to 2 minute. All right, so we're now seeing price give you that reaction, and right after that reaction, we see our last sell to buy candle, right? And not only that, but there's a tiny, inefficiency. Oh, you could just call that efficient pricing. I don't want to force it, right? But that, I don't consider this mitigated. So this now creates this sponsored candle zone, right? Anywhere in here is where you want to basically take your position. You could put the stop right at the low, or you could put it under the wick. But since price opened below that closure, that's where I would want to put my stop, right? So necessarily with sponsored candles, you can either put your stop at the low, right, or at the open of the next candle, right? Preferably the open of the next candle in case there's a gap in price, blah, 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 you know. But still, that's still a 4-point stop, 40 pips, right? And in this market, that's nothing. It depends on what contract size your broker has, but yeah, it's almost nothing, right? So now from here, your first target can't even see that 23 to 1, right? That first intraday / swing target. Now your first swing target would be there, 32 to 1. Second swing target all the way to the high, right? 48 to 1, etc., etc., etc. It even went all the way to 60 something to 1, right? So that's crazy. So that just shows you the power of that concept, the power of understanding, that ratio, right? And even if you missed that entry, you still got one last entry, which was here, right? So price is going to give you multiple opportunities to get in the move, right? Because all this is a scaling between buys and sells and a scale in and out of buys and sells. So that's why you see the price move in such a zigzag pattern, because it's all accumulation distribution of buys and sell orders. So even this position here, pff, 83 points, massive, right? You're still going to catch basically the whole move, right? You can have one leftover swing position, but make sure you have targets at liquidity highs and lows. Here, they're highs. So any of these highs have targets on them, right? Even if you understand the full bigger time frame direction, don't be ignorant of it, right? And as you can see, we got one last entry in this area here for that continuation to the upside. Notice these are all, continuation setups. Why? Because the regular trader is so basically accustomed to understanding that they only want to look for those reversal patterns, right? Where in reality, yes, we understand what sponsored candles are. Yes, we understand some sort of order flow. Yes, we understand imbalances, blah blah, whatever. But at the end of the day, if you can't understand structure, then you're never going to make any bread, because you can chase every candle, but if you don't understand the structure to it, then you're more than likely not going to, be successful, right? So notice this last area here came to, right, discounted pricing to then continue higher. That's always going to be your first confirmation. But the sponsored candle here is obviously this one. Why? Because notice that this was that last down candle to then move up higher, right? Well, actually, it was here. I'm sorry. So this is the last down move before the upside candle. But notice there's wick here, right? So that's not enough data for me to see. So like I tell you guys, every time frame is just showing the same information repeatedly. So I want to see what's inside that wick. And what's inside that wick? It is this candle right here. So obviously the setup here is always going to be this. All right, but notice after that first reaction, that reaction and that reaction, notice we didn't take out the low, we only added on to it. So that's now telling me that there is equal lows there, right? And in order for price to continue higher, I'd like for those equal lows to be taken, which is what happened here. As you can see, right, we're still in the sponsored candle range, but we had to purge that liquidity first, right? You can literally just call this type of move a liquidation move, because all it did is it took out that liquidity just to then come back up, which is exactly what it did. So this continuation setup, right, your first target, right, 5 to 1, second target 7 to 1, third target 8 to 1, and then you can literally just hold this. You can just hold this because you know you're continuing trend on a daily time frame, so there's no reason to basically close unless you have that structure break, right? So this had a potential of 13 to 1, and notice these are all like, they're all, let's say, 10 to 20 to 1 trades, but you're stacking these while you're at the same time taking profits. So that's exactly how you literally play one pair and just basically compound your account like that, right? So notice right after that impulsive move that we have no sell orders to accommodate that. Therefore, this is considered inefficient pricing, right? So now when I'm looking at that, I want to go to a daily time frame, a higher time frame, to understand what's going on, right? Now we're seeing that there are wick continuations to the upside, right? Rejections to the upside, right? So now that we know that bias is still up, this is where we saw that H1, right, inefficiency. So the first point of interest is obviously going to be this high. Why? Because there is sell orders here and then there's buy orders here, meaning that price is now balanced in this area here. However, now that we are up here, let me zoom into that. Now that we're up here, right, this is now all inefficient pricing, right? So it, as you can see, it reacted right off of that previous high, right? So now let's actually look at what happened. Right, so what do we see that happens right here? We see volume start to become stagnant, right? Meaning there's some sort of moving coming. And as you can see, there's a diminishment of sell volume. Then here is where you see the shift. As you can see, the selling volume diminishing, right? Shifting, and now we see bullish volume, right? So we now see the completion of the diminishment, and then we see the shift, and now is when we want to see that bullish reaction. So even there, anywhere in this area is where you could take risk, right? Because you understand volume, right? So even if you caught it right after that first sign of strength there, right? Let's say you even want to give it, I mean, the only thing about this is that you're guessing your stop, right? But let's say you even give it six point stop, right? But now you got that basically that full on break of structure, right? So that's where your safe entry is going to come in, right? So let me go to this 3-minute time frame, just so the data doesn't look as messy right? Like as you can see, this is now the full-on breaker structure, right? Because it took out that previous high there. And now, due to that happening, that caused the inefficient pricing to happen, right? Between wick to wick. And then we see price react off of the 50. Right, let me go back to the 1 minute. Right, price reacted right off of the 50. You can put your stop under the low, right? Because now you have a structure break. You either put it under the low or you could put it right at the inefficiency, right? And in case that failed, you always have that second entry at that sponsor candle there, right? So never be afraid to take risk as long as there's some sort of confirmation to each one, right? So now, right, you got your entry down. Inputs. Right, so now your first target is obviously the previous high, right? That's 9 to 1. Your next target is 15 to 1, which is that swing high, that all-time high. And then in case that breaks, you just want to hold this now. So now you can see how that's going 25 to 1, etc., etc., etc. And there's probably nothing stopping this now, just because this even here can be, an inefficiency 50%, right, to only continue higher. So as you can see, you got to follow the trend, and you're going to get so many opportunities. Like as you can see, there was opportunity here, opportunity here, opportunity here, right? Literally at every pullback, there's opportunity. And each one of those trades, if you hold them that long, right, 378, 375, 350, 375 plus 350, that is 425, 725 plus 725 plus 250. As you can see, that's 1,000 points plus basically another 100 just to round it off, right? So that's 1,100 points. And from knowing that this is an index, 1 point is 10 pips. So that is 1,100 points, aka 11,000 pips, if I did the math right. Yeah, I hope I did. But yeah, guys, now you get the point, right? It's not about, knowing that pip count, but it's just to show you what can happen if you can understand the trend and continue it. So yeah, guys, I appreciate y'all hopping on this. Hopefully I'll get some more videos out with time. I just get a little bit caught up with school, but yeah, guys, I hope you guys enjoyed this, and until next time.